like, share, and subscribe. Wishing you happiness and good luck every day.
You hear the name Warren Buffett, and you immediately think of wealth, right? Of incredible, almost legendary success. For decades, people have tried to figure out the secret of the Oracle of Omaha. But what if I told you the key wasn't some hidden formula, but something he's been sharing with the world out in the open this whole time?
Just look at this number for a second, 362,319%. No, that's not a typo. That is the actual overall gain of his company, Berkshire Hathaway, from 1964 all the way to 2008. To give you some perspective, the S&P 500, the benchmark for the entire market, gained just over 4,000% in that same time. It's not even close.
I mean, it's a staggering figure. It almost defies belief. And it leads to the big, multi-billion-dollar question, how on earth is that even possible? What's the magic formula? What does this guy know that everybody else seems to be missing?
Well, here's the thing. The key isn't some super complex algorithm locked away in a vault somewhere. It's actually been hiding in plain sight this whole time. The real secret, the real sauce, is found in the brutally honest, incredibly insightful, and often pretty funny annual letters he writes to his shareholders, who he always calls his partners.
So to really decode his success, we first have to understand the man behind all those numbers. Let's dig into the Buffett mystique, because believe me, he is way more than just a typical capitalist.
I mean, this is the great paradox of Warren Buffett, isn't it? He's one of the richest people on the planet, yet he still lives in the exact same house he bought way back in 1950. His salary? It's been $100,000 a year for over 25 years. He wants to make money for his investors, not off of them. He chalks up his incredible success to what he calls the ovarian lottery, just being lucky to be born in America. And then, in 2006, he gave away his entire $31 billion fortune. The man is a master at creating wealth, but he is just not a materialist. And this whole unique way of thinking, it feeds directly into his most powerful tool, what you could call his secret weapon for building trust and educating his partners, the letter. The difference is really night and day. On one side, you have your typical CEO letter, right? It's full of PR spin, corporate jargon, and it tends to just gloss over any mistakes. But on the other side, you've got Buffett's letter. His goal isn't to sell you or spin you, it's to actually educate you. He's famous for his unfiltered honesty, and what's really amazing is how he just openly admits his mistakes, often in great, and you can tell, painful detail.
It all really boils down to this simple golden rule. He genuinely tries to put himself in his investors' shoes. When he sits down to write these letters, he literally pictures himself writing to his two sisters, Bertie and Doris, who have most of their money tied up in Berkshire stock. And he knows they want straight answers, not a bunch of corporate gobbledygook. And that one simple act of empathy, well, it just changes everything.
So, this mindset, this idea of treating investors with real empathy, it leads directly to his core philosophy. Shareholders aren't just faceless names on a list, they are true partners in the business. And for his partners, he provides a brutally honest report card every single year. Okay, so this is it. This is the actual performance table from his 2008 letter. This is his report card. Column 2, that shows Berkshire's annual change in per-share book value. Column 3 is the S&P 500, and column 4 is the difference. His one and only goal is to consistently beat the market's performance over the long haul. And as you can see, in all but 6 of those 44 years, he did exactly that. So if he's not obsessing over the day-to-day stock price, what is he focused on? This concept right here, intrinsic value. In simple terms, it's just an estimate of all the cash a business is going to generate over its entire lifetime. It's the real underlying worth of a company. Now, since that's kind of hard to calculate precisely, he gives investors per-share book value as a pretty good stand-in.
And this focus on per-share value is absolutely critical. He learned this the hard way. In 1993, he bought a company called Dexter Shoe, but he didn't pay with cash. He used Berkshire stock. He essentially traded away shares that are now worth over $3.5 billion for a business that eventually went to zero. It was a painful multi-billion-dollar lesson. Using your own valuable stock as a currency to buy something else dilutes every single partner's ownership. He still calls it his worst mistake ever.
And this is where he really stands apart. He doesn't just admit his mistakes, he puts them under a microscope and even makes fun of himself. He openly talks about buying conical Phillips stock right at the peak of oil prices, a move that cost Berkshire billions. This kind of self-deprecating honesty builds an incredible amount of trust, and just as important, it keeps his ego in check,
a skill that is so rare and so critical for a CEO.
You know, Buffett sees his main job not as a CEO, but as what he calls a CCAO, a Chief Capital Allocation Officer. His number one task is to take the cash that all his businesses generate and invest it wisely. And to do that, he uses this beautiful, simple framework for categorizing any business: the great, the good, and the gruesome.
So here's how he breaks it down. First, you have a great business, like his See's Candies company. It earns these fantastic returns, but it needs almost no new money to keep growing. It's just a pure cash machine. Second, you have a good business, like flight safety. It also earns attractive returns, but it constantly needs to reinvest capital, buying new multi-million-dollar flight simulators just to keep that growth going. And finally, you have the gruesome business. This is a business that just eats up enormous amounts of capital to earn tiny, pathetic profits. His classic example? The airline industry.
He put his feelings on these gruesome businesses pretty bluntly. He once wrote this: "Indeed, if a far-sighted capitalist had been present at Kitty Hawk, he would have done his successors a huge favor by shooting Orville down. It's dark humor for sure, but man, it makes an unforgettable point about industries that just consistently destroy money no matter how much they grow."
Now, his letters aren't just for billionaires. They are absolutely packed with timeless, actionable wisdom for every single investor. So let's run through a few quick, rapid-fire Buffett bites.
First up, a core principle he got from his mentor, Ben Graham. Price is what you pay, value is what you get. It's so simple, but so profound. The stock market ticker, that shows you the price, which can be totally irrational and emotional day to day. Value is the real intrinsic worth of the business itself. A smart investor never, ever confuses the two.
I love how he makes these complex ideas so simple. Whether we're talking about socks or stocks, I like buying quality merchandise when it is marked down. It's really that easy. Find a wonderful business and then just wait patiently for a moment of market panic or fear to buy it at a sensible, discounted price.
He uses these fantastic analogies to warn people against getting caught up in speculation. He talked about the housing bubble as a chain of folly, and he used this example of a salesman approving a loan based on a fake asset by saying, "That certainly looks like a $2,000 cat to me." He just knew that that kind of institutionalized nonsense had to end badly.
And this brutal honesty extends to his biggest missed opportunities. He once had the chance to buy a TV station for $35 million that later became worth nearly $1 billion. And how did he describe his own thinking at the time? He borrowed a line from writer Molly Ivins. If his IQ is any lower, you would have to water him twice a day. I mean, can you imagine any other CEO talking about themselves like that?
So when you boil it all down, it all comes back to this one central theme. Buffett's incredible, world-changing financial success, it isn't built on some secret formula or a complex algorithm. It's built on a legacy of candor, of just telling the truth.
And that leaves us with one final and I think crucial question. The proof is right there in the numbers. A 45-year track record of just stunning performance, built on transparency, partnership, and admitting when you're wrong. So, if telling the truth is so profitable, why is it still so incredibly rare?
You know, there's this document. It's published by thousands of companies every single year, and it can act like an MRI for a business. I mean, it can reveal its true character, its hidden strengths, and even its fatal flaws. The crazy part? Most people just toss it aside. But today, we are going to learn how to read it, and we're going to use the master himself, Warren Buffett, as our guide. We're about to see what most investors miss completely.
Buffett actually opens his own reports with this exact mindset. Think about that. In a world of flashy graphics and slick videos, he says the most powerful tool for understanding a business is just words. But not just any words, carefully chosen words. This really sets the stage for everything we're about to uncover. It's not about pictures, it's about clarity, and it's about honesty.
All right, so here's our game plan. First up, we're going to look at this document that's basically hiding in plain sight. Then, we'll dive into a really critical difference between two types of investors. From there, it's all about the Buffett way. We'll learn his golden rule for spotting a great leader, and finally, we'll wrap it all up with a powerful metaphor that connects everything, the corporate thumbprint.
Okay, so every year, public companies release an annual report. Tucked right inside is a letter from the CEO. Now, officially, its purpose is pretty straightforward. Update investors on the results, share the vision for the company, and give an outlook for the future. For a lot of people, it's the only direct communication they will ever have with the person running the show.
Isn't that just incredible?
I mean, companies spend enormous amounts of time and a ton of money putting these letters together. They get input from consultants, executives, maybe even the CEO actually touches it. And for what? For the most part, they just end up in the digital trash bin, totally unread. And that's the crucial question, isn't it? If this is your direct line to the leader of a company you've put your hard-earned money into, why on earth wouldn't you read it? Well, it turns out investors have some pretty good reasons to be skeptical.
The reasons for all of this skepticism are what you might call the usual suspects, right? A lot of these letters just feel like PR fluff, packed with corporate jargon that's designed to confuse you, not clarify anything. There's also that nagging suspicion that the CEO whose name is at the bottom barely even glanced at it, let alone wrote it. But there's another more fundamental reason they get ignored. By the time the letter comes out, a lot of investors have already moved on. And that issue of timing, well, that points to a much deeper shift in the market.
So the reason that timeliness matters so much today is because the very nature of stock ownership has changed. There is a fundamental divide in how people approach the market, and it really separates everyone into two totally distinct camps.
Just look at this number, 9 months. That is the average length of time someone holds onto a stock today. Now, just a few decades ago, that number was around 3 years. So if you're planning on being out of a stock in less than a year, why would you bother reading some dense, long-term letter from the CEO? The answer is, you wouldn't. You're not an owner, you're just renting.
And this right here is the core difference. Buffett calls short-term traders stock renters or flippers. They see a ticker symbol, a price that just wiggles up and down. But a true owner, they visualize themselves as a partner in a real business, something they plan to hold on to indefinitely, kind of like a family farm or an apartment building. And that annual letter, it's written for the owners.
Which brings us right to the philosophy of Warren Buffett. And his approach, it's not just a strategy for picking stocks. It's a completely different way of thinking about the entire relationship between a company and the people who fund it.
Just listen to that language. Co-venturers, remainder of their lives. Wow, he's not talking to temporary capital providers. He's speaking to partners who have entrusted him with their entire financial future. This completely reframes the purpose of a shareholder letter. It's not a marketing document anymore. It's a partnership update.
And this philosophy actually has a name. It's called owner-manager capitalism. It's such a simple but really radical idea, and it's all built on trust and transparency. In this model, the CEO isn't just a manager, they're a steward, and they treat shareholders like true partners. And that annual letter, that becomes the primary way they prove it, year after year.
Okay, so we get the philosophy. It makes sense. But how do we actually put it into practice? How can we, as investors, use the shareholder letter to tell the difference between a true owner-manager and someone who's just, well, going through the motions? This is it. The golden rule. It's so simple, yet it's incredibly profound. As you read a CEO's letter, just ask yourself this one thing. Does this sound like what an honest business partner would tell me? Are they candid about their mistakes? Are they crystal clear about their strategy? Or does it feel like they're trying to sell me something? This one question cuts through all the noise.
So how does a serious investor actually do this? Well, they don't just read one letter. They study them over time. You keep 5 years of reports on file. That way, you can see if the CEO's vision is consistent, or if it changes with every new trend that blows through. You can see if the promises made back in year 1 were actually delivered on by year 5. And this is critical. You can track how accounting figures are presented and sometimes, quietly readjusted later on. It's real detective work.
All of this analysis, all this reading between the lines, it's all in the pursuit of one single thing. It's about uncovering something that is unique and absolutely unforgeable about the company.
And this brings us to a really powerful final metaphor. Just think about it. Every single person on this planet has a thumbprint that is theirs and theirs alone. Well, in the same way, every company has its own unique identity. It's a combination of its culture, its values, and its way of doing business that sets it apart from all the others. So, this corporate thumbprint is the sum total of a company's character. It's not the mission statement they hang on the wall. It's the reality of how decisions get made, how money gets allocated, and how people are treated. It reveals the true quality of the leadership and the real health of the culture. And here is the final crucial takeaway. A great shareholder letter, one that's candid, clear, and consistent over many years, it isn't just a report on the numbers. It is a detailed map of the company's thumbprint. It lets you, the owner, see the intricate design of the business that you're a partner in.
So I'll just leave you with this question. Whether it's a company you invest in, or maybe the one you even work for, have you ever tried to read its thumbprint? That letter, the one that most people ignore, it might just be the best tool you have to get started. You ever wonder if there's a secret way to pick winning stocks? Some kind of hidden clue that tells you what's really going on inside a company, way more than any financial report could? Well, I'm here to tell you there is. And believe it or not, it's been hiding in plain sight this whole time. Today, we're going to decode the CEO's annual shareholder letter. And what we find might just change the way you look at investing forever.
So, think about it. When you're sizing up a potential investment, where's the first place you look? The numbers, right? Of course. The balance sheet, the income statement, that's what we're all taught. It's investing 101. But what if I told you that by focusing only on those numbers, you're actually missing the biggest, most important part of the entire story? Yeah, we're trained to trust the numbers. They seem so solid, so objective, black and white. But here's the hard truth, kind of the dirty little secret of the accounting world. Every single number you read on a financial statement is, at its core, an estimate. It's a best guess. It's a snapshot of a moment that's already in the past by the time it gets to you. And see, those numbers don't just appear out of thin air. They're the end result of countless human decisions, of judgments, of interpretations. And all of that is shaped by the company's culture. So if you really want to understand what the numbers mean, you first have to understand the people who put them together. And to do that, well, you've got to read their words. Okay, so if we're going to figure this out, we need a benchmark, right? A gold standard for what great communication actually looks like. And for that, there's really only one place to turn: Warren Buffett. His approach with the Berkshire Hathaway letters pretty much wrote the book on how this should be done.
Just listen to this. This right here, this is a totally radical idea. He's saying he doesn't see himself as the big boss and the shareholders as just a bunch of people who gave him money. No, he sees them as partners. It sounds like a simple word choice, but that little shift in attitude, well, it changes absolutely everything about how a company is run and, more importantly, how it talks to you.
And that's the key right there, this partnership attitude. When a CEO genuinely sees you, the shareholder, as a partner, it changes the entire dynamic. It forces them to be transparent. It forces them to be respectful. It means they're talking with you, not just talking at you. Honestly, this mindset is the absolute bedrock of any leadership you can actually trust.
So if the CEO is your partner, then that annual shareholder letter, it stops being just another boring corporate report. It becomes a conversation. You can think of it as an annual test of that partnership. It's where the CEO has to stand up in public and answer for their leadership, their integrity, and their vision for the future that you're both building together. And look, this isn't just some feel-good theory. Get a load of this. Studies have shown that somewhere between 40 and 60% of a stock's value is tied directly to how investors feel about the CEO. That's right. More than half the value of a company can be wrapped up in one person's reputation. And where do you think that reputation gets put on display for the whole world to see? You got it, right there in the shareholder letter.
So when we're reading this thing, what are we really looking for? Well, you're getting an insider's look at the person running the show. Are they all left-brained, just spitting out analytics with no soul? Or are they all right-brained, with grand visions but no clue how to actually get there? The best leaders, of course, are a mix of both. Do they speak plainly, or do they hide behind a smokescreen of confusing corporate jargon? And here's the big one. Do they hold themselves accountable? Do they admit what they got wrong last year, or do they just quietly sweep it under the rug and hope nobody noticed? This right here is where you find the real story.
Now, I know what you're probably thinking. This all sounds pretty fuzzy, right? Subjective. How in the world do you measure something like honesty? But what if you could? What if there was a way to turn all these qualitative feelings into cold, hard data? Well, that's exactly what some researchers did. They created a framework to actually score these letters for Candor.
And the process was pretty genius. First, they just dove in. They analyzed hundreds and hundreds of these letters to find the patterns. What topics kept coming up? What writing styles did people use? Then they started assigning points. You get positive points for good habits, like being upfront about goals. And you get negative points for the bad stuff, like using vague, weaselly words. Finally, you just add it all up, and boom, you have a Candor score that you can use to rank every single company.
And here's a little peek at how it works. A CEO who lays out clear numeric goals, that's plus 10 points. That shows real accountability. Taking the time to clearly explain the company's competitive edge, that's another 5 points. But start using a bunch of corporate buzzwords and spin, that's minus 5.
And trying to be evasive, that'll cost you 10. By putting a number on these things, you suddenly have an objective way to measure how straight a CEO is shooting with you.
Okay, so we can score these letters. It's a pretty cool academic exercise, I'll give you that. But so what? Does any of this actually matter in the real world, for real investors? Is there a payoff to all this work? The answer is a huge, resounding yes. And what it shows us are some of the brightest green lights and the biggest, scariest red flags you'll ever see.
And here it is. This is the kicker. When you take these Candor scores and you line them up against actual stock market performance, the result is absolutely staggering. The companies with the highest scores, the ones with the most honest, transparent, partner-like letters, they don't just do a little better. They consistently and dramatically outperform the companies at the bottom. The connection is impossible to ignore.
So the takeaway here is incredibly simple, but also incredibly powerful. Honesty, clarity, that whole partnership attitude, these aren't just fluffy, feel-good ideas. They have a direct, measurable link to financial success. It's like one researcher's mom always told him, it literally pays to tell the truth.
But here's the thing. This is a two-way street. If a clear, honest letter is a big green light, then a confusing, evasive one is a massive, flashing red flag. These muddled, hard-to-read letters, they aren't just the sign of a bad writer. They are very often the first visible crack in a company's foundation. They're the smoke that tells you there's a fire somewhere you can't see yet.
And ignoring these red flags can be absolutely catastrophic. I mean, just think about Enron. Long before that company completely imploded in one of the biggest scandals ever, the warning signs were all there. They were right there in their shareholder letters. They were a complete mess of jargon and confusion, a lightning bolt in the sky telling anyone who was paying attention that a massive storm was on its way.
And lest you think Enron was just a one-off, the same exact pattern showed up with AIG right before the 2008 financial crisis. Their communications were so unclear, so unable to explain the gigantic risks they were taking in simple terms, it was a huge red flag that should have made everybody take a much, much closer look. These letters, you see, they really are the canary in the corporate coal mine.
So I'll leave you with this question. The next time you're looking at a company, thinking about putting your hard-earned money into it, are you going to just jump to the numbers, or are you going to read the letter first? Because that letter, it gives you the story behind the numbers. It tells you about the culture, about the leader, and about the future in a way that no balance sheet ever could. So give it a try. Who knows? It might just be the edge you've been looking for.
All right, let's get right into it. Think about a corporate annual report. What pops into your head? My guess is glossy photos, charts that make your head spin, and just a ton of corporate jargon, right? Well, once a year, a document comes out that people actually want to read. I mean, they read it like it's a bestseller, not some stuffy financial statement. I am, of course, talking about Warren Buffett's annual letter to the shareholders of Berkshire Hathaway. Today, we're going to tear this thing down and figure out what makes it a genuine masterclass in communication and why it's become, without a doubt, the most anticipated report in the entire business world. You know, the whole thing really boils down to one simple but incredibly powerful idea: candor. I mean, total honesty. Buffett puts it right here, front and center in his company's own owner's manual. For him, being straight with people isn't just about good ethics, it's a core business strategy. He believes that the moment you start misleading your investors, you're on a very slippery slope to misleading yourself. And that one idea, that's the thread that's going to run through everything we talk about. So first up, let's talk about what I'm calling the anti-CEO letter. See, the fascinating thing here is that for Buffett, the shareholder letter isn't just something he writes. It's one of the most important things he reads. He actually pores over the letters from other companies, and he uses them as a key tool to decide where he should invest his money. He's looking for CEOs who sound less like they own the place and more like they're responsible stewards of his capital. He's hunting for authenticity. But you might be asking, how does he really know if a CEO is being genuine? Well, his answer is classic Buffett. Direct, this quote just says it all, doesn't it? There's no secret formula, no checklist. You can just feel authenticity. For Buffett, if a CEO outsourcing the writing of their letter, they're basically outsourcing their own thinking. Writing it yourself forces you to get crystal clear on your strategy, to really face your results, and to talk like a real human being. It's not just some task you check off a list, it is fundamental to the job. Okay, so we've established that authenticity is absolutely key, but how does he pull it off with such incredible clarity year after year? I mean, it's one thing to say, hey, write your own letter, but it's a whole other thing to turn it into a masterpiece. To understand that, we have to know who he's really talking to. And believe me, the answer is probably not who you think it is. And when you actually see the process laid out like this, you start to get a sense of the sheer effort that goes into this thing. This isn't just something he whips up over a weekend. It's a year-long process. It literally starts the second the last letter goes out the door. He's jotting down ideas all year, connects them into a first draft around August, and then, and this is key, he sends it to his longtime editor and friend, Carol Loomis. After she tears it apart, he says he basically has to start all over again. This isn't a project, it's a marathon of deep, strategic thinking. And here it is. This is the secret sauce. While he's going through all those grueling rewrites, he's not picturing some Wall Street analyst in a suit. Nope. He's picturing his sisters, Bertie and Doris. Now, they're smart, and most of their money is tied up in Berkshire stock, but they're not financial wizards. So he literally imagines writing the letter directly to them, Dear Bertie and Doris, and that simple little mental trick forces him to be clear, direct, and completely honest. And these are the questions he knows they'd ask. They are brutally simple, and because of that, brutally effective. Did we make money this year? What's the plan going forward? What are the real risks? I mean, there are no evasions allowed. The big takeaway for anyone in a leadership position is right here. Imagine your smartest, most important stakeholder who isn't an expert in your field. Are you speaking their language? He knows if he tried to dodge a question, the next family dinner might get a little awkward. The sister's test is his ultimate BS filter. All right, so he's got his audience locked in his mind. The next ingredient in this recipe is how he explains really complex ideas. He doesn't drown his sisters, or us for that matter, in financial jargon. He tells stories. He uses these amazing parables to teach fundamental economic truths in a way that just sticks in your brain. And let's be clear, these letters are not short. They average around 12,000 words. That is absolutely epic compared to the typical CEO letter. But here's the crazy part. People in the business world call it the longest, fastest read there is. Now, how is that possible? Because every single one of those 12,000 words has a job to do. You know, Buffett would probably paraphrase the great Ma West and say something like, "It's not the number of words in my letter, it's the life in my words." And that just perfectly sums up his whole philosophy. Who cares how long it is if the content is engaging, clear, and actually important? His view is if someone has trusted you with their life savings, they deserve a hell of a lot more than a few paragraphs of corporate boilerplate. Let's look at a classic example to see what I mean. You remember the dot-com bubble back in the late 90s, right? The madness. Buffett famously sat it out, and a lot of people thought he'd finally lost his touch. Investors were just throwing money at companies with no profits, sometimes no revenue. All they had was a .com at the end of their name. He described the whole scene as a party fueled by effortless money. Now, after the bubble burst, he didn't gloat. He didn't say, "I told you so." Instead, he taught. He wrote this incredible parable about the experience, and he described the market as this grand ball where everybody knows they have to leave before midnight. But here was the problem. He wrote, "They are dancing in a room in which the clocks have no hands." Wow. What a powerful, chilling metaphor for pure, irrational speculation. And the ending to his little Cinderella story was, of course, inevitable. If you overstay the party, if you ignore the fundamentals, it always ends the same way, with pumpkins and mice. The magic just evaporates, and you're left sitting in the cold, hard reality. With one simple story, he taught a timeless, unforgettable lesson about the crucial difference between investing and just gambling. This brings us to what I think is the most radical, most important part of the Buffett letters. We live in a world where CEOs are terrified of admitting weakness. It's all about projecting strength. And then there's Buffett, who openly, and often with a lot of humor, walks you through his biggest screw-ups. And you quickly realize this isn't a weakness at all. It's the ultimate sign of confidence and control. He has flat out said that buying Dexter's shoe back in '93 was the worst deal he ever made. He paid $433 million for it, and almost immediately its competitive advantage got completely wiped out by foreign competition. And he doesn't just mention it in passing. He quantifies the disaster, takes 100% of the blame, and then writes something incredible like, "But I'll make more mistakes in the future. You can bet on that." And you know, his self-critique covers both sides of the coin. On the one hand, you've got errors of commission, bad decisions he actually made, like buying Dexter's shoe. But then he also details his errors of omission, the home runs he failed to swing at. Like in 1972, he passed on the chance to buy an NBC TV station for $35 million. That station went on to be worth over $1.8 billion. He's just as hard on himself for the great moves he failed to make as he is for the bad ones he did. But what makes these confessions so brilliant is how he does it. He uses this incredible, self-deprecating humor. To explain how he could have possibly missed out on that NBC deal, he actually quoted the writer Molly Ivins to describe himself. This kind of humility does two very important things. First, it builds just an immense amount of trust with his shareholders. And second, it proves his ego is not running the show. He's not afraid to look foolish, which, ironically, is what makes him look so incredibly wise. Okay, let's pull all these threads together. We've got authenticity, we've got clarity from writing to his sisters, we've got teaching through stories, and this profound humility about mistakes. But so what? How does all this touchy-feely stuff connect to actual results? Well, Buffett gives you the answer, the ultimate proof, right at the very beginning of every single letter. He gives you his final report card. This is it, a dead simple table. On the one side, Berkshire's performance. On the other, the S&P 500. And he shows you the numbers for every single year since 1965. There is nowhere to hide. There's no spin, no adjusted earnings, none of that nonsense. It's a completely unfiltered, long-term look at how they've done. He's basically saying, look, here are the results. This is what you should judge me on. This simple table is the foundation that all of his candor is built on. And over the decades, that relentless candor has built something that goes way beyond just a bunch of shareholders. It has built a genuine community. The letter always ends with an open invitation to the annual meeting in Omaha, Nebraska, and it's become this pilgrimage. Over 30,000 people show up every year. It's like a festival of capitalism, and it's all built on decades of trust, a trust that gets renewed every single year with a simple act of writing an honest letter. So as we wrap this up, it really leaves us with one big question, doesn't it? Buffett has proven, beyond a shadow of a doubt, that radical honesty isn't just a moral high ground. It's a massive competitive advantage. It builds unbreakable trust, it clarifies your strategy, and it creates real lasting value. Which really makes you wonder, in our world, a world that is just overflowing with corporate spin and carefully crafted PR messages, what is the true price of silence? When you think about a successful CEO, how do they get graded? It's all about the daily stock price, right? If the line goes up, they're a genius. If it goes down, they're a bum. But what if I told you that one of the greatest investors in history, Warren Buffett, thinks that's a completely ridiculous way to measure success? Well, today, we're going to look at Buffett's real report card. And here's a spoiler. It has almost nothing to do with that little ticker you see on TV. So here's our game plan. First, we're going to look at why Buffett is playing a totally different game than the rest of the market. Then we'll break down the three core pillars of his thinking: why cash is king, what intrinsic value really means, and his #1 rule about protecting shareholder value. And finally, the fun part. We'll look at the actual report card and see if any of this stuff actually worked. All right, let's kick things off. To really get what makes Buffett tick, you first have to understand that he's on a completely different planet than most CEOs when it comes to measuring success. You know, it really boils down to two completely different games being played on the same field. On one side, you have pretty much the rest of the world, totally obsessed with the daily drama of the stock ticker. It's a game of minutes and hours. But Buffett, he's playing chess while everyone else is playing checkers. His goal isn't to look good on the 5 o'clock news. It's to slowly, methodically increase the real underlying value of the business for every single person who owns a share over decades. He's not watching the scoreboard. He's building a dynasty. Okay, let's dig into the first pillar of his philosophy. And this is where it all gets very real because it starts with something tangible: cold, hard cash. So you might be asking, why is he so obsessed with cash instead of profits, the thing everyone else talks about? Well, it's because reported earnings can be, let's just say, a little squishy. You see, accounting has rules, but it also has loopholes. There are all sorts of ways to make the numbers look better than they are. But cash, you can't fake cash. It's real. It's the fuel that a business actually runs on. You can't play accounting games with your bank account. For Buffett, cash is the ultimate truth detector. And this quote, man, it just says it all, doesn't it? Think back to the financial crisis in 2008. The entire world was panicking. Cash was scarce. People were selling everything. But Buffett, sitting on a mountain of cash, saw it completely differently. He saw the stock market like a butcher shop putting all its best cuts of meat on a clearance sale. He was thrilled. It was a chance to buy incredible companies for pennies on the dollar, all because he had the cash ready when nobody else did. So if he's not looking at the stock price, how on earth does he decide what a company is actually worth? Well, it all comes down to this core concept, the second pillar of his strategy, something called intrinsic value. So what the heck is intrinsic value? Look, in simple terms, it's an educated guess. It's an estimate of all the cash a business is likely to spit out for its owners over its entire lifespan. The key thing here is it's not what the market says it's worth today. It's what the business itself is fundamentally worth based on its ability to generate cold, hard cash in the future. Now, Buffett's the first to tell you that this is more of an art than a science, but we can simplify his thought process into 4 basic steps. First, you try to estimate all the cash the business will produce in the future. Second, you discount that, because $1 tomorrow isn't worth as much as $1 today. Third, and this is absolutely crucial, you build in what he calls a margin of safety, basically giving yourself some wiggle room in case you're wrong. And finally, you divide that whole thing by the number of shares to get your per share value. Okay, I know what you're thinking. That sounds like a ton of work. And it is. Buffett gets that. So for the rest of us mere mortals, he offers a much simpler substitute, per share book value. It's way easier to find. You just take a company's assets, subtract its liabilities, and divide by the number of shares. Is it perfect? No, but it's a solid, conservative place to start to get a feel for what a company is really worth. And that brings us to the third and final pillar, and honestly, this might be the one that most people overlook. It's this ironclad discipline around per share value. This is so important. Just look at this table. Imagine a company earns $5 million and has 1 million shares. That means your piece of the pie, your earnings per share, is $5. Simple enough. But what if the company decides to issue 4 million new shares? The total earnings are still the same, but now there are 5 times as many slices of the pie. Your piece just shrank from $5 down to 1. You've been diluted, and your ownership is worth less. And believe me, this isn't just some textbook theory. Buffett learned this lesson the hard way. In fact, he calls it one of his biggest mistakes ever. It was the purchase of a company called Dexter Shoe, way back in 1993. So he buys this company for $433 million. But, and this is the absolute kicker, he didn't use cash. He paid for the entire thing using shares of his own company, Berkshire Hathaway. Now, hold on, because this is where your jaw is going to hit the floor. At the time, that stock was worth $433 million, but it also represented 1.6% of Berkshire Hathaway. He traded a piece of his phenomenal business for this shoe company. Well, fast forward about 14 years to 2007. That same 1.6% of Berkshire wasn't worth $433 million anymore. It was worth $3.5 billion. The true cost of that mistake wasn't millions, it was billions. I mean, he says it right there in his own words. He basically traded a piece of a diamond for a rock. It's a brutal, multi-billion-dollar reminder of why you have to be so careful about giving away pieces of your own company. All right, we've gone through the whole philosophy, this intense focus on cash, intrinsic value, and per-share results. So now it's time for the million-dollar question, or in this case, the multi-billion-dollar question. Did any of it actually work? Let's check the report card. At the end of the day, this is all that really matters, right? Did this whole ignore the daily noise strategy actually deliver better results than just, buying the whole market? And the beautiful thing is, we don't have to guess. Buffett lays it all out for everyone to see year after year. This is the data straight from his 2008 shareholder letter. On one side, you have Berkshire's growth in book value, his favorite yardstick. On the other side, the S&P 500, which is basically the benchmark for the whole market. Let's see how it played out. Okay, first, let's look at Buffett's grade. From 1965 all the way to 2008, that's 44 years, Berkshire's per-share book value grew at an average of 20.3% every single year for over 4 decades. That is just an insane level of consistent performance. So how'd the market do over that same time? The S&P 500 clocked in at 8.9% per year. Now, don't get me wrong, that is a perfectly fine return, but it's not even in the same league. It's less than half of what Buffett's approach delivered. But here is where the mind-blowing power of compounding kicks in. That yearly difference adds up to something staggering. Over those 44 years, the S&P 500 had an amazing overall gain. But Berkshire, its overall gain was over 362,000%. It's a number that barely seems real. The difference isn't just big, it's monumental. So there it is. That's the playbook. It's not magic, it's just a simple, powerful framework, a goal focused on real cash, a way of valuing companies based on their true worth, and a strict discipline to make sure that the owner's slice of the pie only gets bigger, not smaller. That's the recipe that produced those incredible results. So I'll just leave you with this one question. The next time you see some company all over the news, what are you going to focus on? Are you going to get caught up in the frantic, day-to-day dance of the stock price? Or are you going to try to look a little deeper and ask yourself, what is this thing really worth? Now, you've got the tools to start figuring that out. You know, when you think of Warren Buffett, what's the first title that pops into your head? Probably CEO of Berkshire Hathaway, right? I mean, it's what's on his business card. But what if I told you that title, it completely misses the real story? What if his actual job, the very secret to his genius, is something else entirely? We're going to peel back the layers on that today.
So let's just get right to it and ask the big question. What is Warren Buffett's real job? Because if you can understand the answer to this, you've basically got the master key to the entire Berkshire Hathaway playbook. It's got very little to do with managing people or day-to-day operations in the way we usually think about it. Nope, it's something much, much more fundamental.
Okay, so on one hand, you have your classic CEO. Business schools teach us that their job is to set the strategy, run the operations, you know the drill. But then there's this other role, one you don't hear about as much, the CCAO, the Chief Capital Allocation Officer. Now, this person's number one job is deciding where the company's money goes, which projects get the green light, which businesses do we buy, where can we put this cash to get the absolute highest return possible. And for Warren Buffett, this isn't just a part of his job, it is his job. All right, so here's our game plan. First, we're going to nail down Buffett's true role as CCAO. Then, we'll uncover the secret fuel that powers his whole investment engine. We'll take a walk through how he built his empire, piece by piece. After that, we'll dive into his simple but absolutely brilliant framework for sizing up any business, the great, good, and gruesome. We'll see that in action with 3 real-world examples, and then finally, we'll boil it all down to one powerful, simple rule from his playbook.
So we've pretty much settled the what. Buffett is, first and foremost, a Chief Capital Allocation Officer. But now, let's get into the how. See, at Berkshire, strategy isn't some fancy PowerPoint deck. It's the direct outcome of Buffett's decisions about where to put the money. His principles on capital allocation are the whole navigation system, and that system needs a very special kind of fuel.
Right. To be a great capital allocator, you obviously need capital. And this gets us to the absolute secret ingredient for Buffett's entire operation. His decades of success really come down to his relentless hunt for a very specific type of money, low cost, or even better, free capital. And he found the perfect source for it in a place most people would never even think to look. And that source is the insurance business. The magic word here is float. It's a concept that is honestly beautiful in its simplicity. Float is just the cash an insurance company gets to hold on to in that gap between when you pay your premium and when they eventually have to pay out a claim. It's not technically Berkshire's money to keep forever, but in the meantime, they get to invest it for their own profit. So here's how that works. It's a simple 3-step dance. First, Berkshire's insurance arms, like Geico, collect all of our premium payments right up front. Step 2, Buffett takes that giant pile of cash, the float, and he invests it. Stocks, whole companies, whatever he wants. Finally, step 3, way down the road, claims get paid out. Now here's the kicker. If they run the insurance side of things well, meaning they take in more in premiums than they pay out in claims and expenses, they actually get this capital for less than free. It's like someone paying you to hold on to their money. And the scale of this is just, it's hard to wrap your head around. By the end of 2008, do you know how much float Berkshire had piled up? $58 billion. Just let that sink in for a second. $58 billion of other people's money that Buffett could use as the raw material for his capital allocation machine, and he was getting it for practically nothing. This is the bedrock the empire was built on. So how did this mountain of cash turn into the Berkshire empire we know today? Well, it wasn't a random shopping spree. It was a masterclass in smart capital allocation, and it started from next to nothing. It all began back in 1956 with just over $100,000 in Omaha. Then, in '65, he gets control of this dying textile mill called Berkshire Hathaway. Now, a normal CEO would have just poured money into trying to fix the textile business. But Buffett, the CEO, did the exact opposite. He essentially starved the textile business, giving it only what it needed to barely survive. And he used every other penny of its cash flow to buy better businesses. So in '67, he buys National Indemnity Insurance. Bam! He's got his hands on that precious float. Then, in '71, he buys this incredible cash machine called See's Candies. And then, when the market tanked in '74, he deployed all that capital and went on a bargain hunt. You see the pattern here, right? systematically moving cash from businesses with low returns to opportunities with high returns. Now, this long history of brilliant decisions wasn't just luck or guesswork. It was all guided by a simple yet incredibly powerful framework he uses to analyze any business. He sorts every potential investment into one of three buckets: the great, the good, and the gruesome. This is his mental model for seeing what really matters. And to make this really hit home, Buffett uses this fantastic analogy. Think of every business as a savings account. A great business, that's like a savings account with a crazy high interest rate that keeps going up, and you barely have to put any new money in. A good business has a pretty attractive interest rate, but to make more money, you have to keep making new deposits. And a gruesome business? Well, that's just a terrible savings account. It pays a horrible rate, and even worse, it forces you to keep shoveling more money in at those same terrible returns. Okay, theory is great, but let's see how this works in the real world. Let's look at Buffett's framework in action, with a tale of three very different businesses, each one a perfect example of one of his categories. First up, the great. For Buffett, the absolute gold standard, the prototype of a dream business, is See's Candies. I mean, on the surface, it's just a chocolate company, right? Slow growth, but underneath that, it's something truly special. It is a pure cash machine. So, back in 1972, Berkshire bought See's for $25 million. At the time, it was making less than $5 million a year before taxes. A nice, solid little business. But now, look at this. Since that day, See's has produced more than $1.35 billion in pre-tax earnings for Berkshire. I mean, that's just an unbelievable return on that initial $25 million. But believe it or not, that's not even the most important number. The really critical number is coming up next. So to generate that $1.35 billion in profit, how much more money did Berkshire have to sink back into See's to grow the business? Just $32 million total, over decades. That, right there, is the definition of a great business. Massive profits on a tiny, insignificant amount of new investment. It just gushes cash. And this quote just brilliantly shows you what Buffett, the CAO, does with all that cash. He doesn't just let it pile up in the candy business. He takes it and buys other businesses. As he put it, See's was like Adam and Eve. It gave birth to all these new streams of cash that he could then send out to populate the rest of the Berkshire empire. All right, next up, the good. Flight safety is a perfect example. It's the world leader in pilot training, a fantastic business with a huge competitive advantage. As Buffett likes to say, picking a competitor would be like taking the low bid on a surgical procedure. But, and this is a big but, to grow, it needs a constant stream of brand new, very expensive flight simulators. We're talking $12 million a pop. So it's a good business, it earns good returns, but it's thirsty. It needs a lot of capital to keep growing. It's that savings account where you have to keep putting more in to earn more. And finally, the gruesome. The poster child for this category is the airline industry. These businesses need a bottomless pit of capital for new planes just to stay in the game. But historically, they earn tiny, unpredictable profits for all that investment. Buffett's take on it is just brutally honest and frankly hilarious. If a far-sighted capitalist had been present at Kitty Hawk, he would have done his successors a huge favor by shooting Orville down. And look, he knows this firsthand. He's called his own investment in U.S. Air foolishness, even though he managed to get out without losing money. So when you put this all together, you take the float, you look at the history, you use the great, good, and gruesome framework, it all leads to the single most important rule in the capital allocator's playbook. And the rule is this. It's so simple. You don't have to invest money where you earn it. In fact, Buffett says that's often a huge mistake. A truly great business like See's Candies simply cannot reinvest all the cash it generates and still earn those fantastic rates of return. So the job of the CAO, the job of Warren Buffett, is to take that excess cash from See's and move it to a flight safety or to a Geico or to whatever the best opportunity is at that exact moment. And that really leaves us with one final big question, because this CCIO mindset, it isn't just for billionaire investors. It applies to everything. So I want you to think about it. What's the cash machine in your world? Maybe it's in your business, in your career, or even in your personal finances. And here's the most important part. Are you automatically reinvesting that capital right back where it came from? Or are you stepping back and allocating it to where it can truly generate the best possible returns for you?
You've probably heard the story, right? Warren Buffett, one of the richest people on earth, says he tap dances to work every day.
Now, you might think, well, yeah, I'd be dancing too if I had that much money. But is it really just about the money or the success? Today, we're going to pull back the curtain and look at the real system he built, a system that's all about a level of trust that you almost never see in the business world.
And boom, here it is. This is the key. Notice what he highlights. It's not, I get to be rich. It's, I get to do what I love with people I love. And who are those people? They're his partners, his shareholders. The way he set up Berkshire Hathaway is just a masterclass in earning that love and loyalty year in and year out.
So what does this system of trust actually look like in practice? Because, this isn't just some feel-good story. It's a truly revolutionary business model. And we're about to dig into exactly how he put it all together. And I'll tell you, the answer goes way deeper than just making the stock go up. It's about a set of principles that created a bond that is just completely unique.
All right, first up, Section 1, eating his own cooking. This is the absolute bedrock of the whole thing. Everything he's built rests on this one simple, powerful idea.
Okay, just look at this chart for a second. Back at the end of 2009, Warren Buffett personally owned over 31% of the main shares. Now look at the next slice. The next 8 biggest owners combined barely cracked 3%. That's not just having skin in the game, my friends. That is having your entire heart and soul in the game. It's everything.
And here's the key takeaway. For Buffett, Berkshire isn't just one part of a bigger portfolio. No, it's basically the whole pie. His family's financial future is completely tied to how Berkshire does. And what that means is there is zero daylight between what's good for him and what's good for some person out there who owns just one share. Their interests are perfectly 100% aligned.
Man, this quote, this one really gets to the heart of it. He's not promising that the stock will always go up. No one can promise that. What he is promising is that their boats will rise and fall together. When they win, he wins big. But when they lose, he wants them to know that he is feeling that exact same pain right alongside them. So, next up, Section 2, a different kind of paycheck. If his real money comes from owning the company, just like everybody else, what about his salary? I mean, for a CEO of a company this massive, you'd expect a paycheck with a lot of zeros. But Buffett's answer is, well, it's pretty wild.
Yep, that's not a typo. $100,000. That has been his salary for more than 25 years. And get this, the craziest part? He actually told his board of directors to stop giving him raises. He just doesn't want it. Why? Because his real reward comes from making the company more valuable for everyone.
And this lays out the 2 different philosophies perfectly. On the left, you've got your typical CEO playbook. Your pay is often tied to how big the company is. More sales, more employees, even if it's not more profitable. Plus, you get stock options, which can water down the value for everyone else. But on the right, you have the Berkshire way. A tiny salary, absolutely no stock options, and your pay is based on one thing and one thing only, making each share more valuable over the long haul.
And trust me, he means it. This isn't just talk. The entire Berkshire Hathaway empire, a company worth hundreds of billions, is run out of this famously small, unassuming office. As of 2009, the whole corporate headquarters had just 21 employees. 21. It is the ultimate anti-empire. It's living proof that it's all about creating value, not building the biggest castle.
Moving on to Section 3, the School of Berkshire. So, getting the money side right is huge, but it's really only half the story. The other way Buffett builds this incredible bond is through something else that's super rare. Radical, total transparency, and a real desire to teach.
If you've never read one of his shareholder letters, you really should. They are absolutely legendary. And not just because they're folksy and well-written, it's because he's not just reporting to you, he's teaching you. He takes really complex ideas and breaks them down so that you, the owner, can actually understand the business and judge for yourself how he's doing. He wants smart partners, not silent ones.
I just love this golf metaphor. It's so perfect. He's saying, look, accounting can be messy, but we're never going to try to fudge the numbers to make a bad year look good. We're not going to smooth things out. He's promising to tell you the real score, every single time. Whether it's a birdie or a double bogey, you're getting the truth, warts and all.
So, all this talk of trust and teaching sounds nice, right? But does he actually walk the walk? Let's get into Section 4, Radical Fairness in Action. And we're going to look at a key moment that shows exactly how far he'll go to protect his partners.
So check this out. Back in 1996, Wall Street firms got this idea. Berkshire's stock was getting really expensive, so they started creating these copycat investment funds. They'd basically buy what Berkshire owned, but then they'd slap on huge fees and commissions and sell it to small investors. Buffett saw this as people basically ripping off his followers. So what did he do? He created his own affordable baby Berkshire shares to give everyday people a direct, cheap way to invest, cutting Wall Street right out of the picture.
And this whole thing really shows you the deep conflict between Buffett's philosophy and the way Wall Street usually operates. You see, when a company issues new stock, the bankers on Wall Street often want to discount the price. Why? To sell it fast and lower their own risk. But Buffett looks at that and thinks, wait a second. You're deliberately selling a piece of our company for less than it's worth. That hurts every single person who already owns a share.
And you can just feel the moral outrage in this quote. He doesn't just call it a bad deal, he calls it a crime. To him, doing something that hurts your existing partners just to make a new sale easier is a complete betrayal of trust. For Buffett, fairness isn't just a nice idea, it is a non-negotiable, hard and fast rule.
All right, so let's bring it all together. In our last section, Section 5, the Buffett Golden Rule. You take the total skin in the game, the fair pay, the radical transparency, and this fierce commitment to fairness. What does it all add up to? Well, it creates a way of communicating that is just unlike anything else out there.
Now this is one of my absolute favorite facts about this whole story. Berkshire Hathaway has no investor relations department. Just let that sink in for a second. One of the biggest companies in the world has no team of professional spin doctors. Why not? Because Buffett's view is if you're just honest and clear all the time, you don't need one. He is the IR department.
And this is the whole list. This is the entire communication strategy. It's radically simple. There are no quarterly earnings guidance calls, no special briefings for Wall Street hotshots. Everyone, from the biggest institution to the smallest individual, gets the exact same information at the exact same time. It's built on clarity, not on a giant, expensive PR machine.
And really, if you want to boil everything we've talked about down to a single idea, this is it. This is the secret sauce, the Buffett Golden Rule. It's so simple but so profound. It's not about marketing or spin, it's about empathy. It's about putting yourself in your partner's shoes and just treating them how you'd want to be treated.
So that's the real reason he tap dances to work. It's not just that he's rich, it's that he built a system, a partnership that he can be incredibly proud of. It's the how that matters. And it leaves us with a really powerful question to think about. In this crazy, complex, and often cynical world, what if the single greatest competitive advantage a business can have isn't something you can put on a balance sheet at all? What if it's just plain old, radical trust?
All right, welcome. You know, we live in a world that's just drowning in corporate jargon and market noise. So how do you spot the real deal? I'm talking about a truly great business run by a genuinely great manager. It's a skill that, believe me, once you get it, it can completely change how you see the entire business world. I mean, just think about it for a second. We're getting hit from all sides with data. Earnings calls, analyst reports, these slick presentations. But how do you actually cut through all of that noise and see the true quality of the person at the helm? It's tough, but in this day and age, it's absolutely crucial. So to find our way through all this, we're not going to chase the latest hot trend. No, we're going straight to the master himself. We're going to use the timeless principles of Warren Buffett as our compass. Sound good? Okay, let's dive in. So here's our game plan. We're going to build what I'm calling the Buffett litmus test. First, we'll dig into the financial foundation that great leaders build. Then, we'll look at what really reveals a leader's character. After that, we'll explore their engine for growth. And to wrap it all up, we'll put it together into a simple CEO scorecard that you can start using right away. First things first, let's talk about the money. You know, nothing tells you more about a leader than how they handle the company's cash. It is the ultimate truth teller.
Buffett brought up this old saying right in the middle of the 2008 financial crisis, just as fear was taking over the world. And his point was so powerful because it was so simple. When things get rocky, cash is king. The best leaders, they don't just understand this in theory, they live and breathe it, making sure their company is ready for anything, good times and bad. So you might be asking, how does a company like Berkshire generate so much cash? Well, one of their secret weapons is this concept called insurance float. Just picture it. They collect all the premium money from their insurance customers right up front.
Then they get to hold on to that huge pile of cash and invest it for their own profit, often for years before any claims actually have to be paid out. It is an absolutely brilliant system.
But here's where it gets just incredible. See, most insurance companies actually lose a little money on the policies themselves. They hope to make up for it with their investments. Not Berkshire. Their managers are so disciplined that they consistently turn a profit on the insurance itself. I mean, look at this. In 2008, they were essentially paid $2.8 billion just for the privilege of holding other people's money. That's not just a business, that is an economic fortress.
And to really wrap your head around the scale of this, just look at the size of their float back then, in 2008. $58.5 billion. Just let that sink in. An enormous, practically free pool of capital that a great leader can use to go on the attack when everybody else is running for cover. So the big takeaway here is that a strong financial foundation isn't just about stashing cash away. It's about the discipline to generate it smartly, the wisdom to manage risk properly, and the transparency to explain it all. The fact that Buffett breaks down his financials so simply for investors, well, that tells you everything. That's not just accounting, that's how you build rock-solid, unshakable trust.
You know that financial discipline we were just talking about? It doesn't just appear out of thin air. It comes directly from the character of the leader. And that brings us to our second key area. Because, let's be honest, a strong financial house is pretty much worthless if the person running it has no integrity.
And this really gets right to the heart of it. Talk is cheap, isn't it? I mean, anybody can get up there and give a great speech. But the real test, the only test that matters, is simple. Do their actions actually match their words over the long run? Do they walk the walk? This slide is a perfect example. When Buffett buys these family-owned businesses, he makes these 4 specific promises. See, he gets that these aren't just assets on a spreadsheet you can flip. They're someone's life's work. And by making, and more importantly by keeping these promises, Berkshire becomes what's known as the buyer of choice. And that, my friends, is a massive competitive advantage. Okay, but what happens when things go wrong? Because they always do. Real character isn't just about keeping your promises. It's about owning your failures. And here's Buffett, in his own words, talking about a terribly timed investment. There are no excuses, no blaming the market. He just calls it what it was, a dumb thing that cost the company billions. Seriously, how often do you ever hear a CEO talk like that? And this leads us to a really powerful insight. You want to know if a CEO is truly transparent? Don't just look at their wins. Go looking for their mistakes. Great leaders are not perfect, but the big difference is they're open about their screw-ups. Those confessions, they aren't a sign of weakness. They are the ultimate sign of integrity and strength. Okay, so we've established that a great leader needs financial discipline and a solid character. But how do they turn that into actual sustainable growth? Well, it's all about building the right engine. An engine that's powered by people, by culture, and by a razor-sharp competitive edge.
You know, a lot of analysts just dismiss corporate culture as soft stuff, fluffy, you know? Well, just take a look at this. When Berkshire bought these 2 pipeline companies, they were ranked 9th and a pretty dismal 39th in customer satisfaction. After they brought in a new culture of excellence, bam, they shot up to 1st and 3rd place. That's unbelievable. And Buffett figured that shift alone added over $100 million to the bottom line. So much for soft stuff. That's creating very, very hard cash.
And that kind of culture, it always starts with empowering the right people. Buffett's method is really simple. You hire the best, you give them the freedom to do their jobs, and then you publicly celebrate their successes. He literally uses his famous shareholder letters to praise his managers by name. He gets that genuine, well-deserved recognition is one of the most powerful motivators on the planet. And finally, we come to the ultimate test, a crisis. What do the great leaders do? While everybody else is panicking, hunkering down, they go on offense. Remember all that cash they saved up? Well, now is when they put it to work, making brilliant investments when prices are in the basement. They don't just survive a crisis, they use it to widen their moat and come out so much stronger on the other side. All right, we have covered a lot of ground. We've looked at the financials, at character, and at the engine of growth. Now let's pull it all together into one simple, powerful tool that you can actually use. Here it is, your CEO scorecard. Let's just run down the list. Number 1, they treasure cash. 2, their actions always match their words. 3, they openly confess their mistakes.
4, they nurture a healthy, wealthy culture. 5, they pick and they praise outstanding managers. And finally, number 6, they use a crisis to strengthen their competitive moat. This right here, this is the Buffett litmus test.
So, as we wrap this up, I want you to take this scorecard and really apply it. Think about the leaders of the companies you admire, maybe the company you work for, or even the companies you invest in. Hold them up against these principles, and then ask yourself, honestly, how do they measure up?
You know, when the markets get choppy and everyone starts to panic, who do you listen to? For most of us, for decades, that voice of reason has been Warren Buffett. So today, we're going to crack open his 2008 shareholder letter, which, remember, he wrote right in the middle of the financial crisis, and we're going to pull out his most timeless lessons on how to handle crazy times.
Okay, so picture this. It's the end of February 2009. The entire global financial system feels like it's about to just fall apart. And then Warren Buffett, the most trusted investor in the world, puts out his annual letter, and inside is this one line: the economy will be in shambles throughout 2009. I mean, can you imagine the chill that went down people's spines?
And boy, did people panic. That one soundbite got ripped out of the letter and just blasted everywhere. Headlines, TV news tickers, you name it. And what happened? Just a few days later, the S&P 500 nosedived to its lowest point in something like 2 decades. Now look, you can't blame it all on one quote, but it was definitely like pouring a giant can of gasoline on a fire that was already raging. But here's the part they left out. This is the rest of the sentence. But that conclusion does not tell us whether the stock market will rise or fall. See, Buffett was drawing a massive line in the sand. He was saying, hey, the economy is one thing, but the stock market is something else entirely. A terrible economy doesn't automatically mean stocks are going down. And that single, simple idea is the key to pretty much everything we're about to talk about.
So that brings us to our first big takeaway. Being a truly intelligent investor, it's not really about having some secret formula. It's about your mindset. It's about rewiring your own brain to react differently than the crowd.
And this really gets to the core of how Buffett thinks. Most people see a market downturn and they freak out. They panic, they sell, they think the sky is falling. But Buffett? He sees the exact opposite. He sees opportunity. He actually calls pessimism his friend because it creates a tailwind for buying great things on sale. He's not running from the fire, he's running toward it with a shopping cart.
And please don't for a second think he's somehow immune to all this. This is so important. In that same letter, he's totally upfront that Berkshire Hathaway's portfolio dropped by 14% in 2008. The greatest investor alive lost money on paper, just like everybody else. He felt the pain too, but it's what he did next that makes all the difference.
So what was his brilliant move? What secret strategy did he deploy? He did absolutely nothing. He just sat on his hands. He completely avoided what he calls the Chicken Little syndrome. He knew that owning great businesses meant the loss was just on paper. And by refusing to panic sell, he avoided the single biggest mistake you can make, turning a temporary paper loss into a permanent, real-life loss.
So how does he stay so calm? Well, his entire mindset is built on this one incredibly powerful idea that he learned from his mentor, Ben Graham. It's the absolute foundation of value investing, understanding the crucial difference between price and value.
He summed it up perfectly in this quote you've probably heard. Price is what you pay, value is what you get. It's so simple, but so profound. The price is just that flashing number on a screen. The value? Well, that's what the business is actually worth. It's real, long-term earning power. All Buffett is doing is waiting for the market to get scared, and then he goes shopping for quality businesses that are marked down, just like you would for a good pair of socks. It's that simple.
Now, to really get value, you have to be brutally honest about your costs. And Buffett is a stickler for honesty, especially with this kind of tricky accounting concept called goodwill. All it means is, when Berkshire buys a company, the goodwill is the extra amount they paid above the value of all the physical stuff, the factories, the equipment, etc. It's basically the price you pay for a company's good name and its potential to earn money in the future. Now, here's the thing. Most companies, they just stick goodwill on the balance sheet, like you see here, and then kind of hope you forget about it. But not Buffett. He does something almost no one else does. He insists on showing his shareholders how that goodwill, that extra premium he paid, actually impacts the real-world return on his investment.
And this chart shows you exactly what that honesty looks like. In 2008, if you just ignore goodwill, it looks like Berkshire's businesses had a fantastic 17.9% return. But when you factor in the full price he actually paid for them, the goodwill, the true return on his investment was a much more realistic 8.1%. He's teaching his investors how to think, showing them the true, unvarnished numbers.
Okay, so besides understanding value, Buffett is a master at spotting financial foolishness, especially when bad incentives start linking together to create what he calls a chain of fools.
He tells this brilliant story about the housing bubble. He talks about borrowers who shouldn't have borrowed being financed by lenders who shouldn't have lent, and he imagines this loan officer who's just itching to get his commission, looking at completely worthless collateral, say a house cat, and declaring, "That certainly looks like a $2,000 cat to me." It's such a perfect and frankly hilarious way to describe the madness of pretending something worthless has value.
And the moral of that story is crystal clear. When that bad loan gets passed from the salesman to a banker who bundles it, who then sells it to an investor, you've created a chain of folly. Every single person in that chain is incentivized to just ignore the obvious risk and pass the hot potato to the next guy. But Buffett's warning is stark. That chain will always break, and it will always end badly.
Buffett also has this amazing eye for how the financial world uses language to hide what's really going on. He points out how, over the years, corporate raiders sanitized their name to leveraged buyout operators, which then got a facelift to become the respectable-sounding private equity. He calls it Orwellian because these firms do the exact opposite of their name. They load companies up with debt and actually reduce the equity.
And that leads us to something Buffett has been warning about for years, long before the 2008 crisis even happened. He called them financial weapons of mass destruction. He was talking, of course, about derivatives.
So what on earth is a derivative? Well, at its core, it's just a financial contract, a bet on the future price of something else, like a stock or a bond. The real danger, the hidden time bomb, is that these contracts can sit on the books unsettled for years, even decades. This allows these huge, tangled webs of risk to grow between banks and insurance companies completely hidden from view.
The way he explains the risk here is, well, it's pretty unforgettable. He says with derivatives, it's not just whom you sleep with, but also whom they are sleeping with. He's talking about counterparty risk. Your safety doesn't just depend on the person you made the bet with. It depends on their bets and the bets of the people they bet with, and so on and so on. One failure anywhere in that chain can cause the whole system to come crashing down.
So, naturally, the solution everyone always proposes is transparency. Just make companies disclose more, right? Well, Buffett is not buying it. He says flat out that when he reads the hundreds of pages of disclosures about a company's derivatives, the only thing he knows for sure at the end is that he doesn't know what the real risk is. And his point is, if he can't figure it out, what chance do the rest of us, or even the regulators, really have? Okay, so after all of that, all these warnings about foolishness and greed and these massive hidden risks, you'd be forgiven for thinking Buffett is a huge pessimist. But that is where you would be dead wrong. He ends his letter, written from the absolute depths of the crisis, with this incredibly powerful argument for long-term optimism. He just asks us to zoom out for a second. Look back at the 20th century. In that 100 years, America went through 2 world wars, the Great Depression, something like a dozen recessions and financial panics, not to mention a period of insane inflation where the prime interest rate hit 21.5%. The challenges were just staggering. And yet, through all of that turmoil, what happened? The Dow Jones Industrial Average went from 66 to 11,497. That's not just a statistic. That is proof of an economic engine that, for all its faults and all its periodic bouts of insanity, has managed to unleash human potential in a way nothing else ever has. And so Buffett's bottom line is that he believes America's best days are still ahead. But he leaves us with a really provocative question. That incredible success of the past was built on a foundation of certain values, things like hard work, innovation, accountability. And the question he kind of leaves hanging in the air for us is, do we still believe in those values enough to make sure that our best days are in fact still to come?
All right, hello and welcome. Today, we're going to dig into one of the most important and, honestly, one of the most overlooked documents in the entire world of finance. It's Warren Buffett's Berkshire Hathaway Owner's Manual. Now, this isn't just some boring corporate document. No, this is the entire philosophy that built one of history's greatest fortunes, all written down. So let me just ask you this. What if the secret to all that success was literally written down for anyone to see and almost nobody bothered to read it? I mean, really think about that. We hunt for secrets and life hacks, but here's a detailed blueprint from the master himself, just hiding in plain sight. It's a real mystery, and it's what we're going to unpack today.
Okay, so here's our game plan. First, we'll uncover this forgotten owner's manual. Then we'll get into the DNA behind it all, something called the fiduciary gene. After that, we'll see how Buffett turns a cold corporation into a true partnership. We'll look at the key principles that let him sleep like a baby at night. And finally, we'll see why this whole framework is maybe the ultimate weapon against irrational investing.
All right, so let's start with the manual itself. Back in 1999, Warren Buffett puts out this document, the Berkshire Hathaway Owner's Manual. And he doesn't see it as just some text. No, he calls it his Declaration of Partner-Based Capitalism. I mean, that's a pretty heavy title, right? It's basically the Constitution for anyone who invests with him. And here is where it gets a little bit wild. Buffett literally wants you to read this thing. It's right there in the annual report. It's all over the internet. It couldn't be easier to find. And yet, you ask most people in finance, even people who own Berkshire stock, and they just give you this blank stare. They have no idea it even exists. It's this incredible secret that isn't even a secret.
So what makes this manual so different? You know, Buffett explained it once using this fantastic quote from his partner, the late, great Charlie Munger. It's not about being a saint. It's not about charity. It's about something that's just in their DNA. It's this profound sense of duty to their partners, this fiduciary gene. That's the key that unlocks everything else.
Okay, so let's unpack that phrase, the fiduciary gene, because to really get what the owner's manual is about, you have to understand its genetic code. And it all boils down to this one super powerful idea, being a fiduciary. So what does that even mean? Well, a fiduciary is someone who is legally and ethically required to put your interests ahead of their own. Simple as that. It's a duty to act in good faith, to push your own personal gain to the side for the benefit of someone else. For Buffett, this isn't just a nice to have. It is the absolute, non-negotiable foundation of his whole world. And get this, the sense of duty, he didn't learn it in business school. It seems like it was inherited. Back in 1942, his father, Howard Buffett, gets elected to Congress. Not long after, Congress votes to give themselves a pay raise. But Howard Buffett, he refused to take it. And his reasoning was just so simple and so powerful. He said the salary he was elected on, well, that was the deal he made with his voters, and he was going to honor that deal, period. That is the fiduciary gene in action. And that is the exact same spirit his son Warren applies to every single one of his shareholders. You know, what's really fascinating here is you can think of the owner's manual as a kind of modern-day Magna Carta. For real. Back in 1215, you had these barons who were sick of King John's unchecked power and crazy taxes, and they forced him to sign a document limiting what he could do. Well, that's basically what Buffett did, except he did it voluntarily. He wrote his own contract to limit his own power and spell out exactly what his shareholders can expect. And that brings us right to the heart of the manual itself. Buffett's main goal here is to completely transform the typical cold corporate structure into something way more personal, something aligned. These principles aren't just rules on a page. They create an entire atmosphere of genuine partnership. So the crucial point here is how these rules build an absolute fortress of trust. It all starts with alignment. The attitude is partnership. The directors eat their own cooking, with massive chunks of their own net worth invested right alongside you. Then you've got radical transparency. They promise to be candid about the good, the bad, and the ugly, and to give you the numbers that actually matter, not just some accounting nonsense. And finally, discipline. No vanity projects, no managerial wish lists filled at your expense. This quote about being candid is so important. For Buffett, honesty isn't just about being a good person. It's a critical operational discipline. He's convinced that if you start telling little white lies to the public, you'll eventually start believing them yourself, and that's how you go off the rails. Being transparent keeps you honest with yourself. Okay, now we get to two principles that are so completely countercultural in finance today that one source describes finding them as being as rare as locating a trapdoor on a lifeboat. I love that description. These are the rules that let Warren Buffett sleep soundly at night. First one up is principle number 7. We live in an economy that's been called bulimic. Companies just gorge on debt, then painfully purge it over and over.
Buffett's approach? Use debt sparingly. He will straight up walk away from a fantastic opportunity if it means taking on too much leverage. And in modern finance, that's just bizarre. And this chart just illustrates the trade-off perfectly. Sure, if he took on a ton of debt, he could probably juice his returns by a few extra points. A lot of CEOs would kill for that. But doing that introduces what he calls earthquake-like risk. He is consciously choosing a good night's sleep and stability over a few extra points of return. He's protecting Berkshire's reputation, which is the most valuable asset they have. All right, the second outlier is principle number 11, and this one is pure, unadulterated corporate finance heresy. Berkshire has zero interest in selling any good business that it owns. I mean, none. In a world that is obsessed with optimizing portfolios and trimming the fat, Buffett just holds on. He calls this avoiding gin rummy behavior. You know, where in the card game you're always discarding your worst card? He's making a promise. He won't just hold on to his best businesses. He's even hesitant to sell his worst ones if they're well-managed and making some cash. Why? Because when he buys a company, often from a family that built it for generations, he's buying it for life. And that promise, it builds a level of trust that is just unshakable. Owners of great businesses know that if they sell to Buffett, their life's work isn't going to get flipped for a quick buck. And that trust is the secret sauce. It brings him deals that nobody else even gets to see. It really is the grease that keeps that whole incredible cash machine running smoothly. So let's tie this all together. These principles, they aren't just a list of good business practices. They are a brilliantly engineered system designed to counteract the single biggest obstacle to your success as an investor: your own brain. Look, our natural instincts are just terrible for investing. We're all wired to be emotional creatures. We get greedy and euphoric when markets are screaming higher, which is exactly when we should be cautious. And we get terrified and panic sell when markets are crashing, which is exactly when we should be buying. And this right here is the ultimate genius of the owner's manual. It acts as a rational override for our faulty emotional wiring. When your instincts are screaming, "Panic, get out now," the principles are a calm voice that commands patience. They literally short-circuit those impulsive reactions and give you a clear, logical framework. It's how Berkshire can confidently invest when everyone else is running for the hills. And that brings us to the final and maybe the most fascinating paradox of this whole story. Warren Buffett is a global icon, a financial folk hero. His success is undeniable. The blueprint is written down for everyone to see. And yet, the Berkshire model has not taken over the world. It is still an outlier, a complete business anomaly. Which leaves us with one final thought to ponder. We have decades of proof that this philosophy works. It builds incredible trust, it generates enormous long-term wealth, and it's all built on a foundation of ethical duty. So the real question is, if this model is so clearly superior, why is it still the exception and not the rule?
Welcome to The Explainer. Today, we are diving deep into the world of Warren Buffett. But we're not just going to talk about him as an investor. We're going to explore how his entire philosophy is a direct challenge, you could even call it a heresy, to the very way modern business and Wall Street operate.
So, here's the game plan. First, we're going to dig into why on earth anyone would call Buffett a heretic. Then, we'll break down the specific dogmas he's been battling his whole career. Everything from big academic theories to the insane explosion in CEO pay. And finally, we'll look at the powerful alternative model he's been building all this time.
Okay, let's jump right in. To really understand Buffett, you have to look past that friendly grandfatherly image, because to the financial establishment, he is a genuine troublemaker. You see, those annual letters he writes to shareholders, they're not just full of folksy wisdom. A lot of the time, they're seen as these scathing attacks on how corporate America actually thinks and behaves.
This quote from Charlie Munger, Buffett's longtime partner, is honestly the key to everything we're talking about. Buffett's real genius isn't just picking the next hot stock, it's his incredible, almost unique, ability to spot and just completely throw out these old, broken ideas that everyone else in the financial world still treats like gospel.
Now this right here is where it gets really interesting. Think about this analogy. Just like Galileo came along and proposed this new model of the universe that completely threatened the powers that be, Buffett proposed a radical new center for the universe of capitalism. He basically argued that it shouldn't revolve around short-term greed and just making deals. No, it should revolve around long-term ownership and taking care of things, stewardship. And just like with Galileo, the establishment really did not want to hear it, because it challenged their entire worldview.
So here's what's so critical to understand. You'll hear critics say, well, Buffett never actually created anything tangible, and they're just missing the forest for the trees. His greatest creation is Berkshire Hathaway itself. It's this living, breathing, multi-hundred-billion-dollar proof that his ideas work. It's a company built on a foundation of solid principles, not just hitting quarterly numbers, and that makes it a direct threat to the normal way of doing business.
All right, so let's see how this heresy actually plays out in the real world. We'll start by taking on the first huge piece of Wall Street dogma that Buffett has spent decades trying to tear down, this idea that the market is always perfect and efficient.
You know, for decades, this theory was literally preached like it was the gospel in business schools all over the world. An entire generation of the brightest financial minds were taught that a stock's price is always right. They were told that trying to find an undervalued company, a bargain, was a total fool's errand. It basically told them that the hard work of actually investing was pointless.
Buffett has always preferred a good story to a fancy theory. And to absolutely dismantle the efficient market theory, he had the perfect case study. He knew a guy who proved all those academics were completely wrong, not with some complex formula, but with just plain old, repeatable, common sense.
This is Walter Schloss. He was a friend of Buffett's and his absolute go-to example. I mean, this guy was the ultimate anti-academic. He didn't have a fancy MBA. He didn't use any computer algorithms. He didn't even bother talking to the management of the companies he invested in. He just worked out of a tiny little office with information that was available to absolutely everyone.
And this just shows you the beautiful, almost radical simplicity of his whole approach. You can forget all about macroeconomic forecasts and modern portfolio theory. When his son Edwin was once asked to summarize their, complex strategy, he just said, "We try to buy stocks cheap." That's it. That was the whole game.
And the results of this incredibly simple strategy? Well, over a staggering 47 years, not 1 year, not 5 years, 47, Walter Schloss averaged an annualized return of over 20%. He didn't just beat the S&P 500, he utterly crushed its performance. And he did it without taking these huge, crazy risks, just by patiently buying hundreds of different boring stocks whenever they were statistically cheap. A track record like that over nearly half a century, that's just not luck.
And this is the perfect punchline. Buffett saw the academic world's obsession with the efficient market theory not as a problem, but as a massive competitive advantage. Think about it. While all the so-called smartest minds in finance were being taught that the world was flat, guys like Walter Schloss were free to sail the open seas and discover entire continents of value that no one else even believed existed.
Okay, let's pivot from these big academic dogmas to a very real, very practical fight that Buffett waged for years, right in the heart of corporate boardrooms. I'm talking about his relentless war on excessive CEO pay.
This timeline really shows you his incredible persistence. I mean, this was not some one-off complaint. For years, in letter after letter, he was on a campaign against what he saw as a totally rigged system. He called runaway pay piracy, he called out the obviously biased consultants, he blasted the accounting tricks they used with stock options, and he just ridiculed the absolute absurdity of giving failed CEOs golden parachutes worth millions of dollars.
Buffett just perfectly broke down the flawed logic that boards use to justify these insane pay packages. He called it the compensation committee drill. He explained how a few directors get in a room and they're just bombarded with data showing how much all the other CEOs are making. They hear about the new corporate jets and the new country club memberships, and they fall back on that classic argument every kid uses. But Mom, all the other kids have one. And just like that, what was an outrageous pay package last year becomes the new acceptable starting point for this year.
And his partner Charlie Munger put it even more bluntly. This quote is just so visceral. It's not just disagreement, it's pure disgust. It perfectly captures their complete and total distrust for these so-called independent consultants who are hired and paid very well by the exact same CEOs whose pay they are supposed to be independently setting. It's a massive conflict of interest, plain and simple.
So, after all this time spent tearing down these old, flawed ideas about perfect markets and runaway pay, what's the alternative? What does Buffett build instead? Well, let's explore the powerful, constructive model that he has spent a lifetime creating at Berkshire Hathaway.
This slide just draws such a stark and really important contrast. On one side, you have what you could call the repo agent model. This is common in some parts of private equity. They take over a business, they strip it for cash, load it up with debt, give it a quick makeover for a fast sale, and walk away with enormous fees. And then you have the Berkshire model. Buffett buys great companies with the intention of holding them forever. He wants the managers who built the business in the first place to stay and keep running it, and he wants to build lasting, permanent value for everyone involved. For Buffett, it really all comes down to emotion. He's looking for owners who see their business as a work of art, as a masterpiece that they've poured their entire life into creating. He wants to partner with people who care so deeply about their employees and their legacy that they agonize over what's going to happen to their company long after they're gone, not just someone who's looking to cash out with the highest bidder.
All right, let's bring all this together now with what is really the ultimate lesson from Buffett's heresy. It's all about building something that is designed to last, a culture that can endure far, far beyond any single charismatic person.
And this slide just illustrates the core difference so perfectly. You've got companies that are built entirely around one single, dominant, often brilliant personality. The problem is, when that leader fails or makes a huge mistake or just leaves, the whole thing can collapse like a house of cards. Just think of Enron or Lehman Brothers. But principles-based cultures like the ones you see at Procter & Gamble or Berkshire itself are built on a set of enduring values that allow them to thrive for generations, adapting and succeeding long after the founders are gone. You know, Buffett actively seeks out leaders who just get this difference. When Berkshire bought the BNSF Railroad, its CEO, a guy named Matthew Rose, didn't talk about quarterly earnings. Instead, he wrote about a 112-year-old retired employee. He used that incredible story to highlight the company's long history and the enormous sense of obligation he felt to protect its character for the next 100 years. That's the kind of steward Buffett wants to partner with.
And all of this brings us to our final, lingering question. We've seen the evidence, we've seen the decades of outperformance, we've seen how resilient this model is. So why, after all these years, is Buffett's way of thinking still considered a heresy? Why is a culture built on long-term stewardship, on common sense, and on fair principles still the rare exception in the business world and not the rule? That's definitely something worth thinking about.
All right, let's just jump right in. Woodstock or Camelot? Think about those two words for a second. One makes you think of this huge, messy, beautiful festival all about peace and idealism. The other, a shining, legendary kingdom built on honor, on principle, a noble idea that, in the end, didn't last. What we're going to explore today is how these two powerful, almost romantic concepts frame a very real fight happening in the heart of the business world. It's a battle between serving an ideal, just crafting an image, or, well, giving into simple, straightforward greed.
And our story really kicks off with this powerful statement from Warren Buffett. Now, you got to remember the context here. This was 2002. We were right in the middle of the fallout from huge corporate scandals, Enron, WorldCom. Public trust in business was completely in the gutter. So when Buffett comes out and says it's time to walk the walk, he's not just throwing around a nice-sounding phrase. It's a direct challenge. It's a demand for real, honest-to-God integrity at a time when it was desperately needed. But that's the million-dollar question, isn't it? What does that walk actually look like on the ground? It sounds simple, but as we're about to see, that phrase can lead you down two completely different roads. It's a fork in the road, really, and the path you choose is defined by two profoundly opposite answers to this one question. And that choice, well, it changes everything. So to understand that first path, we have to take a trip to Omaha, Nebraska, for this annual event that's got this kind of quirky nickname, the Woodstock of capitalism. Now, I know, it's a strange comparison, right? But it's a name that Warren Buffett himself loves to use, and it actually gets at something incredibly important about how you build a real community around a shared set of beliefs. I mean, picture this. Every year, tens of thousands of people fly into this one city, but they're not there for the music. They're there to sit in an arena for 6 hours and listen to a Q&A with two guys who are well into their 80s and 90s. And what unites them all isn't peace and love. It's a totally different set of ideals. It's this deep belief in long-term economic value, a real feeling of partnership with each other, and an absolute commitment to just plain old common sense. It's a whole culture, a financial philosophy come to life. Now, this is where it gets really interesting, because we have to draw a clear line between an image and an ideal. See, the name Woodstock, that's just an image. It's clever, it's a great marketing tool, it serves a purpose. But the ideals that the whole thing is built on, partnership, common sense, well, those have a claim on you. An image is something you use. An ideal is something you serve. It's the standard you hold yourself to, especially when you think nobody's looking. Okay, so let's do a complete 180. If Buffett's world is all about ideals that you serve, our next stop is a world built on an appetite that serves only itself.
And this philosophy was captured perfectly by one of the most iconic and, frankly, destructive characters in movie history. And there it is, that famous line. You've got Gordon Gekko, the corporate raider, standing up in front of all these shareholders of a company he fully intends to tear apart, and he just lays his entire worldview on the table. He doesn't apologize for it. He presents himself as a liberator, and his weapon of choice? Greed. He doesn't just defend greed, he makes it sound righteous. He basically reframes it as a law of nature. It's not just a way to make a buck, no. It's this clarifying force that cuts through all the red tape and sentimentality. He says it's the engine of progress, the very thing that drives humanity forward. It's a brilliant, incredibly seductive, and unbelievably dangerous argument. And this is the real masterstroke. He wraps his own personal ambition up in the American flag. All of a sudden, greed isn't just about him getting rich, it's a patriotic duty. He's saying it's the tough medicine that's going to cure a sick and malfunctioning America. He literally sold a personal vice as a public virtue. And you know what? A whole generation of people on Wall Street bought it, hook, line, and sinker. But here's the thing. This wasn't just a great movie monologue. The Gekko Creed became a real-world operating manual for a lot of people. It was the logic that said, sure, push these subprime mortgages on people who can't possibly afford them because you get your commission. It was the logic that said, let's bundle up all those toxic loans and sell them as if they're safe investments. It was a philosophy of short-term personal gain, no matter the cost, and it led us straight off a cliff into the 2008 financial crisis. The results kind of speak for themselves. So you remember Gekko famously said greed was good, for lack of a better word. But what if he was just wrong? What if there is a better word? Well, there is. A much better one, in fact. And it points us toward a completely different way of thinking about business, about wealth, and about what we owe to each other. And this slide just lays out the difference so perfectly. I mean, just imagine Gekko's speech if you swapped out that one single word. Stewardship clarifies, cuts through, and captures the essence of the evolutionary spirit. Stewardship will save the USA. The entire meaning just flips on its head. It shifts from this frantic act of taking to a patient act of caring. The focus moves from what you can pull out for yourself to what you can preserve and grow for everybody else. And that is the absolute heart of stewardship. The best way to think about it is like this. If you're renting an apartment and a faucet starts to leak, you might just ignore it, right? It's not your long-term problem. But if you own the house, you fix that leak immediately because you know you are responsible for the health of the whole place. A steward acts like an owner of whatever they're managing, a company, an investment, a community. They feel this deep sense of duty to leave it better than they found it. So we've got these two clashing philosophies, Gekko's creed of greed and this principle of stewardship. But like Buffett said way back at the beginning, talk is cheap. You have to walk the walk. So let's take a look at the hard evidence, the concrete actions that show what stewardship actually looks like in the real world. You know, plenty of people talk a good game about giving back or being a responsible company. But what's really going on under the hood here? What's the core belief system, the philosophical engine that drives someone to follow through on a scale that is almost impossible to wrap your head around? For Buffett, it all boils down to this incredibly humbling idea he calls the ovarian lottery. And the concept is shockingly simple. He basically says, look, my incredible success in life wasn't guaranteed. Being born a white male in 20th century America with the specific talents I happen to have, I didn't earn any of that. It was, in his own words, dumb luck. And he believes that winning that cosmic lottery doesn't create a privilege, it creates a profound duty to share the jackpot with those who drew a different ticket. And that belief, it's not just some nice idea he talks about at dinner parties. It led directly to this. In 2006, he pledged the vast bulk of his enormous fortune, $30 billion at the time, it's worth way more now, to the Gates Foundation, not to build statues of himself, but to go after the world's toughest problems, like disease and extreme poverty. Just let that number sink in for a second. It's one of the biggest single philanthropic gifts in human history. That is walking the walk. But this sense of stewardship, this duty, it doesn't just stop at charity. It extends to his role as a citizen. Take a look at this number. In a single year, 2003, his company, Berkshire Hathaway, paid $3.3 billion in federal income tax. Now, here's the part that'll blow your mind. That one payment from one company was 2.5% of the entire corporate income tax paid by all U.S. corporations combined that year. Think about that. One company shouldered that much of the national load. And that payment becomes even more amazing when you see the bigger picture here. Look at this chart. Back in 1952, corporate taxes made up almost a third of all the money the federal government took in. By 2003, that had collapsed to just over 7%. So in an age where corporations were hiring armies of lawyers to find every loophole to pay as little as possible, Berkshire was stepping up and paying its share, and then some. And look, Buffett himself has never been naive about this reality. This is one of his most famous and most jarring quotes. It's just a brutally honest admission about the economic imbalance he sees all around him. He's not celebrating it, he's sounding the alarm. He's looking at the way the game is played and is not afraid to say very clearly who's been winning. And all of this brings us back around to that second name in our title, Camelot. The legend of a perfect kingdom, founded on the highest ideals of justice and honor. And just like Woodstock, it serves as this really powerful metaphor for what's actually at stake here. Because here's the thing about the legend of King Arthur's Camelot. It ends in tragedy. The kingdom gets torn apart by betrayal, by human weakness. It fails, it's lost. But the idea of Camelot, that vision of a world where might serves right, where the goal is to build something better, that idea survived. It became a moral benchmark, a story we tell over and over again to inspire people to aim higher. And in much the same way, the example of stewardship, whether anyone pulls it off perfectly or not, it provides a standard for us today. And it leaves us with a set of really clear, really fundamental choices. Are we going to build an economy on stewardship or on greed? Are we going to treat the stock market like a place for long-term ownership of real businesses or like a giant casino? Are we going to be owners or are we just renters passing through? So here's the big takeaway. This isn't just some academic debate between a famous investor and a fictional movie character. It's a live question. It's an active choice that we all face. The kind of world we end up with, the economy we participate in, the values we decide to reward, it all comes down to the ideals that we, as individuals and as a society, decide to serve. The choice is ours, and frankly, it's a choice we have to make every single day.